Hi and welcome to Swiss Codes Daily Market Talk. It's Tuesday, March 4th, the day that the US will go ahead with 25% levies on Canadian and Mexican imports and 20% tariffs on Chinese imports. The US stock investors are obviously disquieted that the tariffs will boost inflation in the US, prevent the Fed from giving the necessary support to the economy and slow growth. The European stock investors, on the other hand, are full of hope that the increased military spending will bring the long-awaited growth back to the old continent. So today is an important day. It marks a turning point in Donald Trump's tariff policy. It is the day the tariff threat will materialize, unless there is a surprise U-turn, of course, and Hammer hopes that the aggressive tariff threats from Donald Trump were not just a negotiation tactic. As a result, the Canadian and Mexican imports will be hit by 25% levies, and the Chinese imports toward the US will be subject to 20% tariffs. In addition, the US will be imposing tariffs on agricultural product imports, said Donald Trump yesterday, starting from April 2nd, and tariffs as high as 25% are also expected to hit the European products sometime in the foreseeable future. So I think I'm not forgetting anything here. Hence, the markets were quite nervous since yesterday, to say the least. The European stocks actually opened the week on a positive note. Remember that, as the clash that we had during the weekend between Donald Trump and Zelensky forced the European countries to, go toward a so-called coalition of the willing, aiming to provide joint military support to Ukraine. Plus, the European Union Commission's President, Madame Ursula von der Leyen, she said that they will relax the rules, the regulations for the European car makers for hitting their carbon emission targets, which were originally set for this year, and give these companies a 3-year window to align with the European regulations, the carbon regulations. In practice, it means that if a European car maker doesn't hit its carbon emission target this year, it will have 2 more years to do so, even if it means that it should increase its efforts for the next 2 years to align. But above all, it actually means that when times are rough, as they are right now, even the Europeans could relax their strict rules and that nothing is written on a rock as such. The prospects of higher military spending from the European countries hope that the strict European regulations that could eventually, or that have been keeping the European companies behind an international competition platform, could be relaxed, and the expectation that the latter cocktail could eventually boost growth in Europe, while further fueled appetite in the European stock markets on Monday's trading session. European defense stocks led the rally. The BAE Systems jumped more than 14.5% yesterday to a record high level. Rheinmetall bounced nearly 14% yesterday. Leonardo gained more than 16%. The French Dassault Aviation and Thales gained between 15 and 16%, and the European car makers were also up at yesterday's trading session, though gains there remain more reasonable. Volkswagen, for example, gained 2.30%, and overall the STOXX 600 index reached a fresh record high, and the DAX was up by more than 3% at some point in the session and posted its best day since 2022. Then Euro bounced more than 1% against US dollar, and the dollar SEK fell almost 2.5%, as the Swedish military industry is now seen as a major beneficiary, a major winner of the rising European defense spending. On the economic data front, yesterday's CPI update from the Eurozone came in slightly higher than expected by analysts. But investors actually focused on the fact that inflation in Europe further eased toward the European Central Bank's 2% monetary policy target, rather than the fact that it is less than expected by analysts. So the further easing in the European inflation actually cemented the expectation that The European Central Bank is heading towards an almost certain 25 basis point cut when it meets this Thursday. Across the Atlantic Ocean, well, the picture was much less full of hope, I'm telling you. The realization that the tariff threats will turn into reality hit sentiment in the American markets, along with some unideal ISM data showing that the US manufacturing activity slowed more than expected in February, while prices paid by businesses rose significantly faster than expected by analysts. And there is no magic, obviously, because the tariffs are now about to make the inflation headache in the US worse, as when you impose 25% tariffs on your biggest trading partners, well, you end up boosting prices at home. And rising inflation expectations that are also self-fulfilling, remember, reduce the Federal Reserve's ability to ease its monetary policy and cut rates to give support to slowing economy. And when the Federal Reserve is no longer there to save the market, to save the day, well, bad news actually become bad news. So here, I think it's very crucial to note that the market sentiment is now influenced less by the central bank policies and the level of yields as a result of these policies, and more by growth expectations. As such, the US yields do continue to fall these days, not on dovish Federal Reserve expectations, but on waning growth expectations in the US. And indeed, Atlanta Fed updated its US growth forecast for the first quarter of this year, and it's now forecast that the US economy will contract by 2.8% this quarter. Yes, 2.8% contraction. As a result, investors are fleeing the highly valued US stocks. The S&P 500 fell 1.76% yesterday. Nasdaq 100 tanked more than 2%. Nvidia tumbled almost 9%, and that despite news that TSM will invest about 100 billion US dollars in the US to diversify operations from the geopolitically sensitive Taiwan. And as such, the rotation trade from American to European equities is strongly in play right now, and is increasingly backed by the waning US growth expectations versus rising European growth bets. And that also boosts the euro against the US dollar, mind you. And that all thanks to Donald Trump. Who would have thought that Europe would become so attractive overnight? Well, in China, the Chinese are kind of dealing with Donald Trump in their own way. They actually announced that they will retaliate by imposing tariffs on US agricultural and food products, and they don't really have a problem with inflation, so they can simply go ahead. Now, the CSI 300 index still slipped below its 50-day moving average today, but we see that the dip buyers are joining in on expectation that the Chinese government could announce new fresh support measures as soon as this week, while the AI optimism around the Chinese big technology stocks, though less sharp these days than a few weeks earlier, could give leverage to the nascent optimism for Chinese stocks. In the energy space, crude oil fell 2% yesterday, below the $70 per barrel psychological mark, not necessarily on trade fears, but on news that OPEC Plus will start restoring output production from April on, because Donald Trump wants cheaper oil prices. So OPEC will actually serve 138,000 more barrels per day to the market from next month, and will gradually restore 2.2 million barrels per day by 2026, abruptly ending the output cut policy of the past 2 years. Whereas oil traders were expecting OPEC Plus to continue to delay its production restoration plans, as oil prices remain well below the ideal levels for Saudi Arabia, for example, which would be above $80 per barrel level ideally. So prospects of higher output later this year are now set to send the price of crude toward the $50 to $60 per barrel range in the coming months in the medium run. Cheers to that. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.